Welcome to The Explainer. So, have you ever wondered how a successful company actually gets its profits into the hands of its owners? Well, today we're going to pull back the curtain on exactly that. We're talking about paying dividends in Mexico. This is your step-by-step guide to moving that cash from the business to the shareholders.
Okay, so let's set the scene. Your company just had a fantastic year. You're profitable. That's a great problem to have, right? But now what? What do you actually do with that money? If your answer is, let's pay the owners, well, you're going to need a plan. You got to do it right, and maybe even more importantly, you've got to do it in a way that's smart about taxes.
So here's what we're going to cover. We've got four main stages. We'll start with the legal checklist, then jump into the company's taxes. That's the CU-FIN rule. Then the shareholders' 10% tax. And finally, we'll wrap up with the last few steps and obligations.
All right, let's dive in. First things first, we've got to talk about the law. Before any money, not even 1 peso, can move, you have to get through the legal checklist. And Mexico's corporate law is super clear on this. There are 3 rules you just can't skip. And here's the thing you absolutely have to remember. The order is everything. You have to do these 3 things in this exact sequence. So number 1, get the shareholders to formally approve the financial statements that show the profit. Number 2, take some of that profit and cover any losses from previous years. And only then, once you've done that, can you move on to step 3, which is funding that mandatory legal reserve.
Okay, so you're probably asking, what in the world is a legal reserve? The easiest way to think about it is like a forced savings account for the company. The law literally makes you do it. Every year you make a profit, you have to take 5% of it and stick it in this reserve. And you just keep doing that year after year until the reserve fund is equal to 20% of the company's capital stock. It's basically the government's way of making sure the company stays financially healthy for the long run.
And here's what that looks like in practice. Let's say you have a net profit of around 97,000 pesos. Well, before you do anything else, you have to calculate 5% of that, so about 4,800 pesos. And that money goes straight into the legal reserve. It's off the table, non-negotiable. Only what's left over can even be thought about for dividends.
Okay, so you've checked all the legal boxes. Now we get to the really big one, the part that affects the company's wallet. Taxes. And what comes next is, honestly, a huge fork in the road. The decision you make here will determine if paying this dividend costs the company just a bit or a whole lot.
And really, it all boils down to one simple question. Has the company already paid its taxes on these profits? The answer to that question is found in one very special, very important account that every single corporation in Mexico is required to keep track of. And that account is called the CU-FIN. Honestly, the best way to picture it is like a tax-paid vault. Think of it as a special container where the company keeps all the profits that it's already paid the 30% corporate income tax on. So when it's time to pay dividends, this vault is exactly where you want to go to get the money. So here it is. This is that fork in the road I was talking about. If you pay the dividends with money from the CU fund, from that tax-paid vault, the company pays 0 additional tax. It's clean. But, and this is a huge but, if you take the money from anywhere else, from profits that are not in the CU fund, boom, the company gets slammed with a 30% corporate tax on that payout. So to put it really simply, your CU fin balance is basically your company's tax-free dividend allowance. You can empty out that whole vault, pay out every single peso in it, and the company won't owe another cent in corporate tax on it. But the second you distribute 1 peso more than what's in that CU fin account, that 30% tax kicks in on the excess. And the way they calculate the tax, well, it's got a little twist. You don't just pay 30% on the dividend amount. No, that would be too simple. First, the government makes you gross up the payment. Basically, you have to figure out what the pre-tax amount would have been. And then they hit that bigger number with the 30% tax. So look at this. A dividend of about 313,000 pesos ends up triggering a staggering 134,000 peso tax bill for the company. Yeah. Ouch.
All right, so the company side of the tax story is done. But hang on, we're not finished yet. The journey for this money isn't over. Now we have to follow the cash into the hands of the shareholder and see what the tax situation looks like for them.
And here we go. There's another layer of tax. After everything the company might have gone through, the individual shareholder has their own tax to deal with, and it's a flat 10% on whatever dividend they receive. But there's a really important catch here, and it all has to do with the year 2014. See, this 10% tax was part of a big tax reform that year, so whether or not you have to pay it depends entirely on when the profits were actually earned. If the profits were generated before January 1st, 2014, they're exempt, no 10% tax. But for any profits earned from 2014 on, that 10% tax applies. I mean, just look at this table. It shows you what a difference a single year can make. You pay a dividend from profits earned in 2013, the shareholder pays zero, the company withholds nothing. But pay out a dividend from profits earned just 1 year later, in 2014, suddenly the company is required to withhold that 10% and send it directly to the government.
All right, we are in the home stretch now. We've tackled the legal stuff, we've figured out the taxes. Now there are just a couple of final administrative things to do to make sure there's a perfect paper trail for everyone involved.
And the law is super specific about this final part. First, how you pay matters. It has to be a non-negotiable check or a direct bank transfer. No cash. This creates a clear record. And second, and this is probably the most important part, the company has to issue an official digital tax receipt called a CFDI for every single payment. And that receipt has to spell out everything. Where the money came from, was it the CUFN, and exactly how much tax, if any, was withheld.
And I really want to stress this CFDI, it's not just some simple receipt you print out. It is the official government-mandated digital proof of the transaction. For both the company and the shareholder, this document is the final word. It's the legal proof of what was paid and what was taxed, and it's absolutely essential when it comes time to file your annual taxes.
You know, one of the experts we looked at, Juan Carlos Victorio Dominguez, he really nailed it. He said you have to think about the financial side of things to avoid, draining the company of its capital. It's a balancing act. First, you need the accounting profits to make it legal. Then you have to check it against the CUFN so you don't get hit with that extra tax. It's a strategic decision through and through. And that really brings us to the final and maybe the most important question of all. Now that you know the how, you know the process for paying dividends in Mexico, you're left with the much bigger, more strategic questions. The why and the when. Is paying out cash right now really the best move for the company's future? Or would it be smarter to reinvest that money for growth? And that, well, that's a decision every single board and shareholder has to make for themselves.